All right, so everyone's talking about NVIDIA, right? Their growth is just off the charts. But what if I told you that behind all those crazy profits, there's this really clever and maybe controversial financial strategy that's got a lot of people talking?
And really, it all comes down to one big question. Is this incredible growth just, pure genius and people wanting their chips? Or is something else at play? A kind of financial jujitsu that people are starting to call circular spending.
Okay, so before we go any further, we've got to unpack that term, circular spending. Because honestly, it's kind of the key to understanding this whole AI gold rush. So what is it? It's actually not that complicated when you break it down. Think of it like this. Company A, let's call them NVIDIA, gives a bunch of money to Company B. Then Company B turns right around and uses that exact same money to buy products from, you guessed it, Company A. The cash basically does a U-turn. It goes out and comes right back. That's the loop we're talking about. So how does this actually play out in the real world? Well, a lot of folks on Wall Street are calling it the AI flywheel. And once you see how it works, you'll get why that's the perfect name for it. Okay, check this out. It's a 4-step dance. Step 1. NVIDIA cuts a huge check to an AI startup. Step 2. That startup, which is starving for computing power, immediately uses that cash to buy a mountain of NVIDIA's GPUs. Step 3, and this is the magic trick, NVIDIA books that sale as pure revenue. Boom, their numbers look amazing. And step 4, they take those profits and start the whole cycle over again with another investment. It's this self-feeding machine. Pretty genius, right? And look, this isn't some academic theory. This is happening right now with the biggest names you can possibly imagine in AI. Let's look at some real-world examples. $100 billion. Just let that number wash over you for a second. That's the scale of the commitment NVIDIA has reportedly made to OpenAI. This isn't just a partnership. This is basically the foundation of the entire AI hardware world as we know it. And this is the perfect textbook example of that circular spending we talked about. OpenAI desperately needs GPUs to train its models, so they pay NVIDIA. Then NVIDIA takes a chunk of that cash and invests it right back into OpenAI. It's this beautiful closed loop. For NVIDIA, they secure their number one customer. For OpenAI, they get guaranteed access to the hardware that is literally their lifeblood. On the surface, it seems like a win-win. But it doesn't stop there. Things get even more interesting and a lot more complicated when we look at a cloud provider called CoreWeave. Tangled web is the perfect description here because this is way more than just a simple circle. We're talking about a $6.3 billion deal, but it's not a straightforward investment. NVIDIA is acting as a capacity backstop. So what on earth does that actually mean? Okay, so here's how this web is spun. First, NVIDIA isn't just an investor, they own a 7% stake in CoreWeave. That backstop thing, it means NVIDIA has promised to buy up any of CoreWeave's server time that they can't sell. This basically takes all the risk out of CoreWeave building out massive new data centers, which, surprise, surprise, are filled with NVIDIA GPUs. But wait, it gets even crazier. OpenAI is also an investor in CoreWeave and one of its biggest customers. You see, it's this tight-knit ecosystem where everybody's fortunes are tied together. And for our last example, let's talk about Elon Musk's AI company xAI. NVIDIA's got another $2 billion on the line here, but the way they've structured this deal, it's a whole other level of financial engineering. So instead of just writing a check directly to xAI, the money is funneled through what's called a special purpose vehicle. Get this, the debt is tied to the actual GPUs themselves, not to xAI's corporate balance sheet. That's huge. It's like financing a car where the loan is only tied to the car, not you. And to top it off, xAI can rent out any chips they're not using to help pay off the financiers. So NVIDIA isn't just a vendor here. They're basically acting like an investment banker, structuring the whole deal to make it as easy as possible for xAI to buy their stuff. Okay, so after all that, is this just a brilliant next-level business strategy? Well, if you talk to the bulls, they'll tell you absolutely. They see this as a smart, even necessary way to kickstart an entire industry from scratch. The argument for it is called the virtuous flywheel. The idea is that NVIDIA is solving the single biggest problem for any AI company, getting access to enough computing power which costs a fortune. By funding them, they're speeding up the whole AI ecosystem. Plus, it cleverly locks everyone into NVIDIA's ecosystem, specifically their software platform CUDA. You can't really use their chips without it. So from this point of view, NVIDIA isn't creating fake demand, they're just smartly meeting a very real and very insane level of demand. But as you can probably guess, there's a flip side to this coin.
And for the skeptics, all of this looks a little familiar. They see some pretty spooky parallels to a time many of us would rather forget.
Yeah, we're talking about the dot-com bubble. Back in the late 90s, you had this thing called vendor financing. Big tech companies would basically loan money to tiny startups on one condition. They had to use that money to buy the big company's equipment. It made the big guys' revenue numbers look incredible. Until you realize the money was just going in a circle and the startups had no real business. Sound familiar? The critics say it's almost the exact same playbook.
And it's not just us making this comparison. Wall Street is definitely raising an eyebrow. You've got analysts at places like Goldman Sachs saying, hey, wait a minute. When a supplier makes an equity investment in a customer, additional scrutiny is warranted. In plain English, that means when you're paying your customer to buy your stuff, we have to ask how much of your growth is real and how much is just self-funded.
So what are the big risks here? Well, there are three main ones. First, you might be pumping up your revenue numbers in a way that isn't sustainable. Second, you're building this house of cards where everyone is so interconnected that if one big player stumbles, they could take everyone else down with them. And maybe the biggest risk of all, a lot of these key AI companies, including giants like OpenAI, aren't actually making a profit. They're burning through cash and completely dependent on these massive investments to keep the lights on. Which all leads us to the $100 billion question. And that's not just a figure of speech here. It's a question for NVIDIA, for OpenAI, for the whole industry. Is this sustainable?
And if you want to see just how fragile this could be, here's a number to chew on. One estimate from Goldman Sachs suggests that by 2026, OpenAI could be short $62 billion in a single year. That is a mind-boggling amount of money they'll need to raise, and it just shows you how much pressure is on this system to keep working.
So, at the end of the day, what's the big takeaway here? It's that a big chunk of NVIDIA's jaw-dropping growth is, in a way, being funded by NVIDIA itself. They're no longer just betting on their own chips. They're making a massive all-in bet on the survival and success of the very companies they're selling to.
And so that's where we are. Is this a virtuous flywheel, a brilliant strategy that's bootstrapping the future of technology? Or is it a fragile bubble, a high-tech version of the dot-com boom just waiting to pop? The truth is, nobody knows for sure, but the stakes couldn't possibly be higher.